What's up everyone, my name's Robbie, this is Robbie in Manila, and today we're talking about dollar cost averaging. So if you're watching this video, you're likely in one of a few different situations. You may be just starting to invest, you have a little money on the side, and you're not sure whether or not to put all of your money into the market right now, or kind of average it in over a period of time. Or you may not have a bunch of money sitting around ready to invest, but you're just trying to figure out whether or not to invest your salary every month and dollar cost average into the stock market as time goes on. Or you may be one of those lucky people who had like a windfall gain, you got $1 million in your bank account, and you're trying to figure out if you should throw it into the stock market all at once, or if you should dollar cost average over a year or 2 years and invest your money over time. So whatever boat you're in, I think you'll have a good idea of what's best for you by the end of this video. So let's go ahead, roll the intro, and let's get started. So before we begin, I'd love to hear in the comments if you're dollar cost averaging or doing something else, and also don't forget to dollar cost average the like button. Okay, so first, in like less than a minute, what is dollar cost averaging? So let's go over 2 examples. Now let's say you have $100,000 and you want to dollar cost average this money into the stock market over the next year. So what you'll do is you'll add $8,333 into the stock market every single month, and at the end of 12 months, all your money is going to be in the stock market. Our other example is that you work full time and you want to put $500 to the side to invest every month. What you're not doing is putting the $500 into like a bank account, into cash, and then waiting for the market to dip or something like that, and then adding all of your money into the market at one time. So you're averaging into the stock market over your lifetime as you make money. So the thing with dollar cost averaging is, let's say if you have a lot of money, it prevents you from having like a July 2008 situation happen, where if you had invested all of your money in July of 2008, within about 3 months, your money would be 50% less. And so in that situation, dollar cost averaging would have definitely helped you out, because you would have only put a little bit into the market every single month and averaged in as the market went down. And so first, let's go over lump sum investing and the idea that you'll actually likely have more money if you lump sum invest your money all at once right now. So here's the thing, historically, the majority of the time, the stock market goes up. In fact, according to Andrew Sather, the percentage of stock market days that were up from 1996 to 2016 was 53.9%. And the percentage of stock market days that were down was only 46.71%. So there's a much higher chance that the stock market's actually going to increase than decrease on any day. So, but instead of looking at a 1-day period, what if you look at a whole year period? Well, according to Nathan Faber, over a 92-year period from 1926 to 2017, the market had positive returns over 74% of the rolling 12-month periods. And so what this translates to is a lump sum investment has a 68% chance of outperforming dollar cost averaging in any 12-month rolling year period if you invest in the S&P 500. And so you probably understand now that the odds are actually in your favor. Because it's more likely that you'll have more money the sooner you invest, lump sum investing is almost always going to outperform dollar cost averaging. So what's this actually mean? It means that if you have money on the sidelines right now, there's a higher probability that you're going to have more money if you lump sum invested that money right now. So if you look at this chart from UpDollars and Data, you'll see a comparison of dollar cost averaging over a 24-month period versus lump sum investing that money into the stock market. And so every time dollar cost averaging underperformed lump sum investing, it's under the 0% line. And you'll see more often than not that you'll have less money if you dollar cost averaged over a 24-month period than if you just invested all your money at once. And so what happens is dollar cost averaging underperforms lump sum investing by 4.3% and underperforms lump sum investment by 73.3% of all months shown. So okay, lump sum investing usually will beat dollar cost averaging, but what if you're just starting out and you don't have a lump sum to invest yet? Well, if you're trying to figure out whether or not to start investing in the stock market or to put money into a bank account and wait, as you can see, the odds are in favor of you having more money if you start right now. Because again, the stock market is up more often than it's down. So it actually makes sense for you to start dollar cost averaging immediately and not to wait. Okay, so that's out of the way, but there is one thing left, and there is actually a valid argument for dollar cost averaging over lump sum investing. Again, going back, if you had lump sum invested all of your money in July of 2008, you'd be pissed. because within 3 months, your money would be 50% less. And so in behavioral finance, there's a saying that you feel the pain of loss twice as much as the excitement of gain. So if you put money into the stock market in a lump sum and the market declines, you feel that more than if it goes up. And likely you have a higher tendency of taking your money out if you just lump sum invest the money and the market goes down. So the question is, what can we do about it? Well, there's two things that you can do. So first, you could dollar cost average over a shorter period of time. So for example, if you were going to dollar cost average over a 24-month period or a 12-month period, maybe make it a 6-month period. You still have less of a chance to have more money, but the probability is you'll have more money if you do it over 6 months than if you did it over 12 months or 24 months. So that's one way, but there's actually another way, and it's that you just invest in a less risky portfolio. And so we can visualize this by looking at Nick Majuli's chart from Of Dollars and Data. And so this chart compares a lump sum investment into a 60% stocks, 40% bond portfolio versus someone dollar cost averaging into a 100% S&P 500 portfolio, or essentially 100% stocks instead of 60% stocks, 40% bonds. And so what you'll see is that dollar cost averaging over 24 months, which is the black line, has a lower return than if you lump sum invested into a 60% stocks, 40% bond portfolio, which is the blue line. And so if you had done this, the dollar cost averaging strategy has a monthly average return of 0.3%, while the lump sum investment has an average monthly return of 0.5%. So again, if you lump sum invested into a 60% stock, 40% bond portfolio, instead of dollar cost averaging over a 24-month period into a 100% stock portfolio in the S&P 500, you'd actually have more money by investing in that less risky portfolio, but lump summing in. And so what's interesting is that you overperformed, but you also take less risk. So this chart compares the risk for the 24-month dollar cost averaging into an S&P 500 portfolio versus a lump sum into a 60-40 portfolio. And as you'll see, the dollar cost averaging into an S&P 500 is the black line. It actually has higher risk in terms of standard deviation than the lump sum into the 60-40 portfolio, which is the blue line, that has a lower standard deviation. So if you're confused, what this is actually saying is that you take less risk by lump sum investing into that less risky portfolio than actually dollar cost averaging over 24 months into a 100% S&P 500 portfolio. And I hope you realize now that there is this option, which is instead of lump sum investing into a riskier portfolio, just lump sum invest into a less risky portfolio. All right, so I hope this helped, but if you're super confused, here's a recap. So first, there's a much higher probability of the market going up than the market going down. This is true over a 1-day period and a 1-year period and more. And so if you're trying to figure out whether to lump sum invest a large amount of money, you're likely going to have more if you invest it right now. And if you're just starting out and trying to figure out whether or not you want to start investing in the stock market and you don't have any money, it's in your favor to start investing and dollar cost averaging your money right now and not waiting. On the other hand, in behavioral finance, they say that people feel the pain of loss twice as much as the pleasure of gain. And so if you do lump sum your money right now and suddenly the market goes down, you're going to feel it more, and there's a good chance that you're going to take your money out of the market. So what can you do to combat that fear of loss but also manage the probability you're going to make more money if you invest right now? So first, you could dollar cost average a lump sum over a shorter period of time. Instead of a 24-month period or a 12-month period, maybe do it over a 6-month period. Or you just dollar cost average into a less risky portfolio. So if you were going to invest in that 100% S&P 500 total stock portfolio, instead, maybe do 60% stocks, 40% bonds, but lump sum it instead of dollar cost average. And so hopefully all this makes sense, and I hope this video really helped you out. If you like this video, please hit the like button and subscribe if you want to see future content kind of like this. So that's all we have for today's video, and please watch another one of my videos on the end screen right now.